You are listening to Keystone's Stock Talk Show, episode 225. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a great show planned for you this week. In our Your Stock Our Take segment, Aaron answers a listener question on Highliner Foods Incorporated, symbol HLF on the TSX, a leading North American processor and marketer of value-added frozen seafood. While the stock offers a strong 4.3% dividend, we continue to have some reservations on the stock, and Aaron lets you know what the business would have to do to become a buy. I will answer a listener question on LightSpeed Commerce Inc., symbol LSPD on the TSX, which offers a unified point of sales and payments platform. Having reviewed and passed on the stock multiple times in the past with it trading at significantly higher prices, a viewer asks us if it finally offers value after announcing it will break even this year. With U.S. cannabis stocks jumping last week, Brett explores the news that sent the sector soaring after 2 years of tough times and whether it is sustainable or more of a dead cat bounce for U.S. cannabis stocks. Last but not least, Brennan revisits a segment he put together back in May on Canadian banks and beginning to extend their mortgage amortization periods and where they are today after reporting their Q3 numbers last week. So let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, and as always, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well. Yeah. What about yourself?
Good.
Back to school. It's back to school.
It's crazy. Summer's over.
Yeah. So Brennan's completing grade 12 this year. Pretty impressive. It's good to hear.
Yes. Finally.
Yeah. Yeah.
Amazing.
What is this? Your
sixth attempt at grade?
Sixth attempt. No, it's not the level 2 CFA.
Brennan's doing level 3 this year. What are we talking about?
It's true. It's true.
Brett and I. Yeah.
Yeah.
We'll both of you guys.
That's right.
Yeah. Lots of studying so far. And my social life's going to go downhill over the next few months.
Thankfully, it wasn't.
Yeah, it's not like it was booming or anything. So
yeah.
Can't go lower than nothing.
Sure.
Sure. Yeah. Your what is going to take a hit? What is your social? That doesn't make sense.
But we will be in Vancouver tomorrow and on Thursday for the Planet Micro. So we're going to be interviewing some companies there. Looking forward to that. Getting out of Saskatchewan for a quick day.
I got 6 or 8 interviews tomorrow as well. I got to give not tomorrow, Thursday morning. I got to give a speech at the event on Wednesday. And then I got to fly out Thursday afternoon with Aaron to Toronto where we're going to the Money Show. And it's Friday, I believe, Aaron, right? We do a speech there. We'll put some details.
At 4:30. Is it 4:30?
Believe around 4:30, around that time, and that's Eastern.
Right around that time, 4 to 4:30. Yeah, I think it ends about 5. So maybe 4:15 is when it starts. 45
minutes. We'll be giving a speech out there. So if you're in the Toronto area or anywhere in the world and you want to fly in and see myself and Aaron, give us 45-minute speech. Markets where we are right now, some selections there too as well. So come into Toronto, the greatest place on earth, as Brennan says all the time. And listen to us speak. Or if you're in Vancouver, I'll be at the Planet Microcap show. I think it's a 5:30 time Pacific on Wednesday of this week. Wednesday, is that the 8th? Brennan, take a look at your calendar. We'll figure it out.
The 6th.
The 6th? I don't know. It's the 8th that we speak in Toronto, right? I knew it was one of those.
The 6th.
Yeah.
You'll be speaking at the Planet Micro Wednesday the 6th. So that's 5:30 Pacific time?
That's right. Yeah. Okay. 5 till 6. And then, some hospitality suite after. That's all I know. Brennan made me aware of that. I had no idea.
Yeah.
All right. Let's get to the show today because we've got a lot of work to get to outside of this show. So let's get to it. Aaron, you are revisiting a company we've looked at in the past, Highliner, and seeing if you can get on board with the Sea Captain. Do you remember the Sea Captain in those commercials from back in the day?
Well, how could I forget? I mean, that was half the reason why I recommended it way back, was the Sea Captain.
Just a crotchety old Sea Captain.
He was an icon of my youth.
He was.
I mean, Highliner is very popular.
You respected him more than any other Sea Captain.
Well, he's also the only Sea Captain I was really familiar with.
Yeah, it's true.
Yeah, good. Okay. So why don't we talk a little bit about Highliner here?
These guys have no idea what we're talking about when we talk about the Sea Captain. It wasn't in their time.
I'll pull up
the Sea Captain
is bring him up
in the current time. Still, it's just not as, I would say, as well known a brand.
There he is.
I feel was very well known when I was growing up, when I was a kid and a teenager. So, 50, 60 years ago.
I think they've handsomeified him there a little bit. He looks more
handsome. He's a little younger than he once was, right? But
I think
it's an interesting company to take a look at, because we actually did have an active buy recommendation on this company way back around 2011. We sold out of it after about a year and a half, 2 years. It ended up performing very well. So I've been looking in on it quite a bit. I'm fairly consistently since that time, to see if there's an opportunity to get back in. But why don't we just walk through the specifics here? So Highliner Foods Inc., the symbol is HLF on the TSX exchange, trades at a price of about $12 per share, $400 million market cap, with 33 million shares outstanding. And what they are a leading North American processor and marketer of value-added frozen seafood. So the retail branded products, which are the ones that Ryan and I were so fond of when we were young, are sold throughout the United States and Canada under the Highliner, Fisher Boy, Mirabelle, Sea Cuisine, and Catch of the Day labels. And they're available in most grocery and club stores. So I see them when I go to Costco. I see them when I go to the superstore. The company also sells branded products under the Highliner, Icelandic Food, Mirabelle, and FPI labels to restaurants and institutions. So more or less kind of almost a wholesale segment. They're also a major supplier of private label value-added frozen seafood products to North American food retailers and food service distributors. So they have wide distribution chains through their business, diversified product offering as well. But essentially what you're getting here, frozen fish sticks. That's the ultimate thing that you're getting. So we'll just take a look. Where's the stock price been over the last 12 months? Pretty flat with a lot of volatility. Stock price hasn't really gone much of anywhere. And that's the same as really what we've seen over the last 10 years. If you go back about a decade, we're seeing a lot of ups and downs in the share price. We're not seeing any sustained growth from the business, at least not in its stock market. Now, when we recommended the company, this was previous to 10 years ago. It was about 2011. We sold out about 2012, 2013. We made a pretty nice return at the time. And what we were seeing was a rather unknown company in the stock market that had just made a major acquisition, had a lot of embedded growth, and was trading at a low valuation. So that was a great deal. And when we sold out is really because the valuation started getting ahead of itself. Also, the financial performance started to slow down. So let's take a look. As I said, we've been looking in on the stock every couple of quarters over the past decade or more. And I'll talk a little bit about some of my observations there. But first of all, let's just take a look at what the recent performance looks like. So Q2 2023 results, they were pretty much flat. Sales volume of 59.4 million pounds of fish, up 1% year over year. Revenues of 254 million, basically flat year over year. The company did see a drop in their gross profit margin to 20.4% from 22.2% in Q2 of last year. So that's a 180 basis point drop. Adjusted EBITDA down 13% to 22 million, and then adjusted EPS basically flat. So if you look at the 6-month numbers, a little bit more growthy, but really not that impressive either. 3.3% sales volume growth, 6% revenue growth. Margins, gross profit margins still down compared to the previous year. Adjusted EBITDA flat, and then adjusted earnings per share up about 7%. Some of the key takeaways from the Q2 results were that softer demand and higher inventory levels in the retail segment of the business is really what had a negative impact on profitability. The food service segment does continue to perform well, and it just completed its 9th consecutive quarter of growth. What the company's looking at doing, which is really continuously the story, it's what they're always looking at doing, is investing in innovation, targeted promotions, and marketing. And also exploring opportunities for transformative growth through potential M&A or acquisition activities. And they have been somewhat successful in that regard over time, but it's not a consistent generator of growth. Usually significant acquisitions are years apart, or else they're smaller, really bolt on, and don't necessarily move the needle. Looking at the balance sheet, total debt of $340 million. Equity of $387 million. So on a debt to equity basis, just under 1, reasonably good. And then debt to EBITDA, based on trailing 12-month adjusted EBITDA of $103 million, you're looking at a debt to EBITDA multiple of 3.7 times. So I think this is a little on the leverage side, given that the company does at the very least produce sustainable profitability. I don't think that the balance sheet is severely over leveraged, but I don't think that there's a lot of space for more leverage here. I would really like to see this multiple down at 3 times or even a little bit less than 3. And then in terms of valuation, if we were to just base this off of the trailing 12-month earnings per share, adjusted earnings per share of $1.53, we'd be looking at a price to earnings multiple of 8 times. Now, usually what I like to do is I also like to throw in some analyst estimates into here so we can get an idea of what the forecasted earnings are for the current year and for next year. Problem is High Liner doesn't really have a lot of analyst coverage. From what I can see, there's 2 analysts covering the company. That doesn't really give a lot of credibility to the estimates. But generally speaking, what we would be expecting would be to see a slight decline in earnings in 2023. And that's more or less in line with what we see with the Q2 results. So, flat to slightly lower earnings in 2023, maybe potentially a little bit of growth in 2024, but we'd have to get into the year to see that. 8 times earnings, that's an attractive valuation. Certainly it's a discount to the market. It begs the question, is this a value opportunity? So I'm going to answer that. What is our take on High Liner? And, really, I think it's an interesting company. It has that recognizable brand, diversified product offering. Its products, again, are widely distributed. And the valuation is low relative to earnings, making it that potential value opportunity. And what you would want to see here from a value opportunity is that valuation multiple to expand. So right now we're at a fairly sizable discount to the market, 8 times earnings. For a company that is still relatively healthy, if not much of a growth stock, but 8 times earnings. And you would want that valuation, either the earnings would grow and the valuation would stay the same, and that's what would create the share price growth, or the valuation multiple would expand maybe from 8 to 10 times, which either with flat earnings or growing earnings would again be positive for the share price. The question is that going to happen? Can we make a reasonable assumption over the next 1 to 2 years that either the earnings are going to grow meaningfully or the valuation multiple is going to expand meaningfully? And I would argue that at this point, we really cannot. The reasons for that is, one, they've really been unable to maintain consistent earnings growth or just consistent growth in revenue over time. And as I'd said, we've been looking in on this company every couple of quarters for more than a decade since we got out of it. And really, they're never able to build sustained momentum in their financial performance. They'll come out with a couple of good quarters, then they'll come out with some poor quarters, and they're really just up and down. And we've seen this in the share price. I mean, the share price has really reflected what's been going on with the financials. One of the things that they have lacked in the past that has really been a challenge for them is passing on higher costs to consumers, so increasing prices. Now, they were able to do that last year in the highly inflationary environment. which is good, but historically they've had trouble with it. Last year might have been a bit of an anomaly given that everybody was increasing prices, but I have noticed them lack pricing power. The balance sheet again is okay, but we would consider it fully leveraged. I mean, it's not a situation where, they're looking to do M&A or acquisition activity. It's not a situation where they have this under-levered balance sheet and a ton of cash, and we think like, oh, they have the capital structure to go out and deploy that and do a big deal and bring it in. They're already pretty fully leveraged. So could they add a little more debt on? Sure. I guess it would just depend on the deal. But, really, I can't make an argument at this point in time that the valuation multiple is going to expand. It may expand just with overall market investor sentiment, but that's really risky to try and predict that. Earnings, as I said, they may go up. The analyst expectations off of the two analyst forecasts is that there'll be a little bit of growth in 2024. But I mean, that's really uncertain right now. We can't say. So I think that probably the stock is appropriately priced from what we can see. Now, if they're able to do anything like a good acquisition deal or string together, several quarters of consistent growth, even if it's a moderate level of growth, then at that point we can see the valuation multiple expand. But I can't make a strong argument that that's going to happen over the next 1 to 2 or 1 to 3 years. So we're not buying it right now. We're going to continue to follow it. It's an interesting business, and what we want to see is it demonstrate a track record of being able to grow consistently on the organic revenue line and also on the earnings line, earnings per share line as well. And that's that.
Yeah. And Brennan said he has that man in his freezer, so you should probably check your freezer and get him the hell out of there.
It was actually Jane's. I had to.
No, I've got Highliner in my freezer.
Did you just go check?
I went and checked. I don't need to check. I went and checked. Yeah. So it's Jane's, and I will say, just like anecdotally, from like a consumer perspective, like I've walked down, the frozen like fish aisle and have seen, a box of fish now, $25 or something along those lines. And it's like, I will push that off. I don't need to buy fish right now, even though, I like that in my diet. It's healthy for you. Get those omegas, as my mother has taught me. But, I just, I wonder if that'll, impact it. And then as well, I was just looking at like the processed foods and feeds, producer price index for fresh fish and seafood. And, we're basically tapping off of, 10-year highs, basically. And it has been doing that since, July of 2022. So, as we've seen some commodity prices come down, I don't know if fish has, it might still remain a little bit elevated right here.
You're worried about the captain. That's good.
Aye.
Let's move on. I think Aaron did a great summary on the company there. I think we know what we need to see from Highliner going forward to, really have us put a buy. I don't think it's a terrible company. Like Aaron said, great brand. But, if you look at it, I looked at the cash flow numbers, inconsistent for 10 years, really. Mm-hmm. Let's look at LightSpeed Commerce Inc. I'm going to handle that. It's LSPD on the TSX, trades at $22.24, market cap $3.38 billion. It's based in Montreal. LightSpeed is a cloud vendor of omni-channel point of sale software to retail and hospitality customers. Restaurants and retail, even Brennan would like it's some golf courses and locations like that. Its software is used by over 160,000 mid-market customers in North America, Europe, and Australia. Let's look at the Q1 fiscal 2024 highlights. The revenues were up 20% to $209 million. Subscription revenues, which are great for the business, were up 7% to $78.7 million. But the company had a net loss, $48.7 million, as compared to a net loss of $100.8 million in the same period last year. So I guess you could say while the company still loses money, it's losing less. Adjusted EBITDA was a loss of $7 million versus an adjusted EBITDA loss of $15.6 million in the previous year. As at June 30th, 2023, LightSpeed has a great balance sheet. About $780 million in cash and cash equivalents with basically no debt. Valuations, the company trades at over 20 times EV to adjusted EBITDA. Its fiscal year 2025 estimates, its trailing price to sales is 3.25. There is no PE as the company loses money. We went over that. We do not expect accounting EPS to be positive for this fiscal year, which is fiscal 2024, or fiscal year 2025. Our take, LightSpeed has stated that it remains on track for adjusted EBITDA break-even or better in fiscal 2024. Revenue should be in the range of 875 to 900 million. This is close to 22% growth over last year. We do appreciate LightSpeed has shown remarkable growth via acquisition and to a degree organically since 2020 or 2016, when it posted just 30.7 million in revenue, to its annual revenue expected this year of around 90 million or 900 million. So this is remarkable growth in revenues. The company raised capital at an opportune time and boasts a huge cash balance of 780 million, like we said, and limited debt. We have answered questions on the podcast when the stock traded in the 140 range, $100 range, $80 range, 60, 40, and down to the $20 range today. Our issue with the business, as it was then, is a lack of profitability. Operationally, the company lost 27 million back in 2016, despite massive growth in revenue. Over the last 12 months, they lost 243 million. Now, the losses on an adjusted basis are decreasing, and management is looking to break even on an adjusted EBITDA basis in the current year or better. Again, this is not a positive accounting earnings, just on an adjusted basis. Losses are shrinking, there's solid revenue growth, and the strong client base that this business has. It is moving in the right direction, LightSpeed is, but still has a long road ahead of it to meet our basic criteria. And that's all I have on LightSpeed today.
You don't understand the technology.
Yeah.
Just kidding.
No, I mean, this is one where you can. It's point of sale systems. It just, it's not making, it hasn't historically made money. And what I do worry with businesses like this, it's great to have that cash, but if you've never needed to have the discipline to be profitable over time, it's a different animal to bring that company into profitability in the long term. So we'll see if this management group can do that. They've not had to do that since really the existence of the company, because they've had cash on the balance sheet significantly, particularly as they've been a public entity. They've had that cash there. So they didn't have the discipline to every quarter make sure they had some cash going into the bank so they could pay the bills. They could pay that out of the money they raised in capital markets. So is this a company that can consistently produce profitability over the long term? We have no idea, because they haven't done it in the past, and they're trying to do that now, but it's still a couple years off until you really see positive accounting earnings on this business. So,
if ever, so let's see that actually happen first, and then get excited about that.
Yes, like we had a question or a comment on the last time that you did it about a year ago on LightSpeed, and this person basically says that I'm so screwed. I got in at $70 and it's now $16. I don't know what to do now. And an individual commented on their post and said average in at a lower price. I mean, seeing the fundamentals right now where they are, and that we're 2 years, possibly further out, you guys would agree that averaging in at a lower price probably isn't the most prudent strategy to continue to accumulate.
The strategy has to be, when you're making that initial investment, if it's a real investment that you're serious about, don't buy businesses that are cash flow negative and expect anything different than to lose your money over the long term. And that's what's happened here. Now, we can't go back in time machine and tell them that at that time. But, it wouldn't be a recommendation of ours right now because it doesn't meet our initial criteria. But you don't get yourself into that situation with LightSpeed of buying at $70. You think, it was at 140, it's at 70, it's down 50%, it must be on sale. Well, the underlying fundamentals then said, do not touch this stock. If you're looking at anything to do with cash flow, or a company that consistently can produce cash flow, it wasn't there. And it's not a surprise for us to see it go from 70 to 20. The investment philosophy that keeps you out of this situation is to buy a business that has cash flow. You wouldn't have bought a company like LightSpeed at that, if that was part of your initial criteria. And it needs to be going forward. Made the mistake, probably get out, and then move to a company that has cash flow going forward.
And hopefully now they're a subscriber and they, follow our philosophy. So they don't make that mistake in the future.
Yeah. I mean, investing in the stock market is tough enough, but if you compound it by buying companies that don't have any cash flow, you're not going to make any money over the long term.
And we've been asked before if there's one piece of advice you can give a retail investor who's buys stocks. What is the best piece of advice? And our best piece, hands down, is don't buy companies that aren't making money. So if they're not making profit, avoid them. If they're not making revenue, generating revenue, don't even consider them. That's about the easiest rule that you can apply to avoid the most amount of risk quite easily.
Very simple. Yeah. All right. Let's move to the cannabis segment very quickly. We got a few questions on why cannabis stocks across the board basically jumped higher last week. Brett's done some investigating. He's going to let you know why.
So going from no cash flow to no cash flow is what you're saying.
Yes.
All right, yes. Like Ryan said, over the last week, we've really seen the cannabis industry stocks just pop in price. So we'll use as a proxy for the industry Advisor Shares Pure US Cannabis ETF, or MSOS, trading on the New York Stock Exchange. At the close on August 29th, so a week ago from this recording, the ETF was trading about $485 and is now trading intraday at $785, a 62% increase within a week. Mind you, that result still only results in a 14% increase year to date after that massive increase in the past week. So why has the industry just suddenly become so revitalized? The answer is simple. Expectations have changed due to the senior U.S. Department of Health and Human Services calling on the DEA to ease restrictions on marijuana from Schedule 1 to Schedule 3, Schedule 1 being the highest designation for the most dangerous of substances. However, the DEA has final authority for any changes to scheduling, and the change is merely an increase in potential at this point. A change in scheduling would likely allow for easier avenues for research, easier access to banking, and less taxation. As well, this does not mean marijuana will be in the same state in the US as it is in Canada. It would still be federally illegal. That would require being descheduled completely, and that's not what we're seeing at this time. But many are seeing this as a step towards that in whatever 5-10 years, whatever timeline you want to give it. So how would this impact equity investors? We would see less taxation as companies are not allowed to use credits and deductions on income from Schedule 1 and 2 drugs at this time. A clear economic benefit, expected savings in the hundreds of millions for many multi-state operators. On the operational side, we'd see access to better banking, which would likely result in lower expenses. As right now, only certain banks allow cannabis players to bank with them, so it increases costs due to that. However, the rescheduling still falls well short of the recreational demand increase like we saw in Canada years ago. In reality, it just reduces the toxicity of the current operating environment for the industry, but that does not alone make an industry. So looking deeper at the MSOS ETF, first off, you may notice that they primarily hold equity swaps, not just common shares. This is due to federal and custodial banking restrictions, limiting direct investing in the equity. As the ETF invests in swaps, it has a large amount of cash as collateral. So if you're looking at the holdings, why do they have this huge cash balance? It's because they have to hold that cash as collateral. They don't really have that cash position. If they were just to buy the equity or the common shares, you wouldn't see that cash position, and they're just using these swaps because they cannot directly invest in common shares. The ETF currently holds 25 companies at this time, with its top 5 holdings being Green Thumb Industries, Curaleaf, TrueLeaf Cannabis, Verano, and Terra Ascend, representing 77% of the total assets held by this ETF. That's likely to shift over the next week, as obviously we've seen extreme volatility, but those are the 5 biggest holdings representing the mass majority of the ETF, and that's unlikely to change as a whole. Looking historically, Green Thumb Industry is the only company that is currently profitable, with TrueLeaf previously having a string of profitability, and those out of the top 5 holdings, those are the only ones who have had profitability historically. As a whole, the industry is really still just in a speculative phase, having the valuations bank on the expectations of future earnings, but that does not mean they will become profitable or have positive cash flows in the future. We can really use Canada as a proxy for full recreational legalization in the US. I will remind the listeners that the potential rescheduling is still far off recreational usage like we've seen in Canada. Cannabis is ultimately a commodity. It is a crop with minimal differentiation from its core products. We are now seeing Canada edibles and drinks and stuff like that adding a bit more differentiation, but the plant as a whole is a commodity. So what results is you see a race to the bottom in pricing as producers produce as much of supply as they possibly can, causing razor-thin margins or even negative gross margins for many of the players in Canada, where you aren't even seeing those harsh taxations like you are in the US currently, where you can't deduct. And still, in the US and in Canada as well, the sale taxes are high. Where it is legal in the US, you see an additional sales tax between 6% up to 37% in Washington, with the majority ranging between 10 and 20% being the sweet spot for most states. Also, there is potential, if we do see federal legalization, that you see more taxes on the federal level, whether that's wholesales or a sales tax of some kind. So, as a whole, the industry is still regulatory high risk in the US, and it will continue to be. It's just slightly, ever so slightly less at this time, but that does not warrant really a 60% increase in valuation, in my opinion. The industry will, in the future, be commoditized and will be subject to high taxes, likely. You might see a couple of states see lower taxation, like I forget which one it was, but at 6%, that's not too bad compared to your 37% in Washington. But the fact is, it's going to likely have high taxes and high commoditization. Those are both very negative aspects for equity investors. Remember, you're not investing in the industry as a whole. The big winner here is the government because they're seeing those tax revenues. You're an equity investor, not an industry investor. So any tangible any tangible market demand is still years out, because you're not going to see a big demand shift with this rescheduling. We're once again seeing just the same headline-driven share price appreciation, which once the interest fades, whether it's a month or a year from now before anything else comes, you're just going to see the current players just slowly burn through their cash for the most part. You'll see their stock just slowly drift away, and they'll dilute their shares to raise their new capital. You might see an outlier or two in the future, not at this time, who do become sustainably profitable. But we're not really seeing that at this time. The best bet at this time would be Green Thumb, but we saw before with TrueLeaf, they were profitable for, I think, about 5 years, and now they're not in the profit anymore. And you may see some investors say, well, I'm going to hedge my bets. I'll buy MSOS to say, hey, I'm going to bet on a bunch of them, and maybe one winner will pop out, but then you're also buying a ton of losers at the same time. So eliminating any of the potential gains from that winner, or just going to loser itself. And just to end it off, the industry is really just still far off from being a buy and hold investable criteria, hitting that criteria. Really anything past being an event-based trader, it's just not really worth touching at this time.
Yeah, I think it's a good summary. It was a recommendation. It still has to go through many hoops before it actually gets to be put into anything that would be meaningful for the sector. Now, again, it's not still full legalization either. So, and on top of all of these things, you went over the scenario in the Canadian market with, cannabis being a commodity, margins shrinking over time. It's just, perhaps, like you said, there could be some winners. It's very difficult to pick them right now. And I think part of the big jump that you saw and have seen over the past few days since this was released was there's such a negative sentiment. There were short positions on many of these companies. It would be short covering, probably just, they're covering their butts at some point. They're probably significant profits. And then that's why you're seeing such an extreme move in the share price in such a short time. That's what I would speculate on, what has caused that really extreme move. So can it sustain itself? Ultimately, the companies have to show better growth, better profitability. Probably some of the competitors have to exit the segment, and then you can have some sustainable players. Now, that's probably going to play out over a 3, 5, 10-year period. So this may be a footnote. I mean, it's a positive note right now for the sector, which is at nothing, but negative for quite a significant amount of time.
And they've been talking about, changing the schedule forever. Cannabis is up there with heroin, LSD, ecstasy, like basically what the Schedule 1 drug says basically too is that it's highly addictive and it has no acceptable medical use. So, I mean, it was only a matter of time that it changed. And then as well, just, to touch again on the commodity, like Ryan was telling me that back in 2014, when he would go to his local dispensary, he was paying about, $200 for an ounce. And now he can buy an ounce for about $100. So, I mean, that's just to show the commodity right there. Right. You were telling me
weird that Brennan knows those off the top of his head, right? Like I couldn't quote you any of those, but it's weird that he knows those off the top of his head. We didn't even tell him we were doing this segment. So.
No.
Anyways. No, but
it's a good sign that maybe the government's moving in a positive direction, but nothing more, nothing to get too excited about.
Yeah, and the as far as like Schedule 1 to Schedule 3, the recommendation, the Department of Health and Human Services recommendations, they are binding on scientific and medical matters. So, like Brennan said, it would suggest that it's likely going to move for sure out of Schedule 1 with the heroines of the world, which most people can agree it's not in that category. So that likely happens, but it's probably going through the timeline into the presidential elections. This is highly politicized, like the it's not legalization, but even moving from Schedule 1 to Schedule 3. So they'll want to be talking about it around those times. So, I mean, that's not until like into 2024. So still a ways out before there's any absolute conclusion. And the larger players that would really take to move the sector long term probably are waiting until they have that green light. And it's not even a full green light. That's what we're kind of trying to get to. Anyways. All right, Brennan, you want to revisit? Let's move on to your segment on the banks. See if in terms of 30 plus year mortgages, they've increased those in terms of their books, more mortgage books, or stayed the same, slightly down. You let us know.
You betcha. So, we did a segment back in May on the Canadian banks beginning to extend mortgage amortization periods on outstanding mortgages to help ease the pain of some Canadians facing higher interest rates and ongoing inflationary pressures. So now that the banks have reported their Q3 2023 results, I guess a couple of weeks ago, I thought that I would go over some common themes we saw with the banks' results. And of course, like Ryan was just saying, see what their mortgages by remaining amortization looks like now. So just quickly on the actual results, several of the banks failed to meet analyst expectations, and only RBC actually outperformed the expectations. And just some of the common themes which they reported here were there was growth in GIC funding as investors flock to higher interest-bearing securities. There were comments that there was a bit of a slowdown in deal-making and mortgages as consumers are more cautious with elevated rates. And a few cited fierce competition for mortgage spreads right now. A couple of banks also discussed reducing headcount, specifically RBC as well as TD. And for TD, they indicated that they had, a few large one-time costs due to the failed acquisition of First Horizon Corp. And lastly, this is probably the biggest takeaway. Every bank reported higher provisions for credit losses. So I have up on the screen here just a few for an example, like BMO. Their provision for credit losses this year was $492 million compared to the same quarter last year, which was about $136 million here. Also just a note to keep in mind, these aren't actual credit losses that the banks have experienced, but it's just that the banks are placing aside more provisions for potential losses in the future. So we'll see kind of how that works out going forward. And I also wanted to show here that some earnings estimates from analysts and that they've been downgrading their EPS estimates as the banks are facing a tougher macroeconomic environment. So we've seen, revisions kind of across the board here. Now, actually moving to the bank's mortgages by remaining amortization, Just as a reminder, in 2021, there were basically no mortgages with an amortization period of greater than 35 years. Now, almost a third of all mortgages in Canada are over, that 30-year amortization. So first, I've got TD up on the screen here. Now they have about 48% of its mortgages with a greater than 25-year amortization, as we ended up seeing an uptick in the 25 to 30-year mortgages and a slight move downward in mortgages greater than 35 years. Now, this is also a similar story with CIBC. 47% of all mortgages have an amortization period greater than 25 years, which was pushed up by growth in the 25 to 30-year mortgages and was again offset by a slight decline in mortgages greater than 35 years. And RBC, lastly, 43% of their mortgages have an amortization of greater than 25 years. And again, there was a slight increase in 25 to 30-year mortgages with a slight decrease in mortgages over 35 years. So I also wanted to bring this up. The Financial Consumer Agency of Canada, or FCAC, we'll call them, said 2/3 of mortgage holders in Canada are having trouble meeting their financial commitments. So in July, the FCAC provided new guidelines for banks on how to deal with at-risk consumers dealing with financial stress, with the aim of standardizing how lenders implement policies and procedures. And some of these items include waiving prepayment penalties, waiving internal fees and costs, not charging interest on interest, and then, of course, extending amortization periods. Now, banks and other lenders will sometimes offer various forms of relief for consumers struggling in these scenarios, so it's not a new thing. But again, the FCAC's new guidelines seek to standardize the approach, but do not actually prescribe direct action that institutions should take. So it's interesting that the Canadian Watchdog is, trying to place these guidelines in just to make sure that we don't have a runaway situation with amortization increasing. Now, I also wanted to show here, just because, I'm in the market for a house one day. Obviously, I'm getting priced out. But I wanted to show Canadian urban housing starts in the last month here. And I actually have it over the last few years. So the standalone monthly seasonal adjusted annual rate of total housing starts for all areas in Canada in July was down about 10% from June. And keep in mind, June was the strongest month so far this year. So we are coming off of a high sequentially. But despite the monthly drop, total housing starts for all areas in Canada was about 7% above the 5-year average. So, I've been seeing a lot of news articles talking about housing starts being very slow. But, if we're looking from a historical perspective, they actually remain pretty robust here. And lastly, I just wanted to finish on the affordability of housing in Canada, where the median resident in both Toronto and Vancouver are paying above 80% of their median income on their mortgage payment. And we can also look at Canada. It remains at approximately 60% across the country. And then when we look at Montreal and Calgary, they come in at better levels of around 40%. So, it's just going to be interesting to see what we see with the housing market over the next couple years here. I mean, you'll continue to see me do segments. Hopefully you continue to enjoy them. But yeah, now I'll just kind of open it up to the gentlemen and see if they have any thoughts or comments.
Interesting chart on affordability. So when we look back, affordability in Vancouver was almost as expensive or almost as bad in the 1980s and 1990s. And in both cases, that seemed to be timed in line with a recession.
Yeah, that is true.
Yeah, and I think the really quite an eye-opening stat is 2/3 of mortgage holders are having trouble meeting their financial commitments.
Yeah,
I mean, it's not a third, which is still a lot.
Yeah,
like 2/3, 67% are having trouble meeting their. I mean, it shouldn't be totally shocking given what's gone on, but you see it plainly in front of you, and I'm not sure how we can't have some kind of a recession coming up if 2/3, 2 out of 3 people are having trouble meeting their financial commitments, and they have mortgages, right? Yeah.
And I just popped like TD back up on the screen here. So in 2021, right? Am I looking? Yes, October 31st of 2021, 28% of their mortgages were greater than 25 years. We are now at what did I write in my piece? It's 46%, I believe, or 47% at CIBC. TD is now 48% of all mortgages are greater than 25-year amortization. So it's just crazy.
Basically half,
yeah, exactly. So it's just crazy to see. And this is something that we'll continue to track, and I'll continue to update my
those mortgages had to be extended clearly, or else the people were not able to afford the mortgage. I mean, that's totally what's going on essentially. Yeah,
totally.
I still think it's pretty much underreported.
Yeah, I agree.
Brennan's the only one who's ever reported it.
Well, when I was initially writing my piece, I was kind of like tooting my own horn, where it's like, oh, finally, there's some news articles that are actually really coming out about it. But yeah, we were ahead of the curve. Yeah.
And if anyone's wondering why the US hasn't popped up, because there is quite a big difference, they haven't really moved.
Yeah.
They use a standard 30-year fixed. They don't really do variable mortgages there. So they're a lot less interest rate sensitive compared to Canada. So it's just
we were going through that. It's crazy how different it is when you're locked in at 3% for 30 years. Like ours, we're locked in for. Some people did 2 years, 3 years, 5 years would be on the longer end for Canadians. A lot do 5, but that's can be on the longer end, right?
And you made the comment too the one time where it's like, no doubt in 2008, the Canadian banks did so much better because, again, the consumers are taking on the interest rate risk more, I guess. So it didn't, or it reverted for Canadians paying lower rates. Anyways.
Yeah. All right. I think that's it for this week's show. We can encourage you to keep your questions coming in for Your Stock, Our Take segments. If you're watching this on YouTube, smash that subscribe button right now. Keep that. And if you're viewing or listening on iTunes, rate and review us on there. All positive reviews, of course. Thank you very much. And we got a busy week ahead, so I'm going to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.